Good morning, Nate. Let's talk about the record highs. We heard Tom Lee earlier this hour. He says the bull run continues. Do you agree?
Good morning. I think the bull run does agree, right? So we have a few things happening over the last few weeks that are bullish for the market, right? The Fed cut for the third time, which they were not doing come last year this time. And also we have a potential phase one trade deal, which will mostly focus on ag purchases, some tariff delays, some currency type of dialogue from China, not so much manipulating so much anymore. And at the end of the day, we're starting to see some cyclicals really turn the corner over the past 8 weeks. You have semis breaking out to new time highs. You have banks outperforming REITs and staples and utilities. So that's all bullish for the market if we're going to keep the cyclical turn going forward.
So how important is the idea that we are seeing the interest rate picture start to, and I use the word loosely, normalize a bit more? We've been highlighting throughout the course of the show the difference in yields between 10-year government notes, U.S. Treasury notes, and 2-year government notes. At one point over the past few months, they were negative. Now we're back up to a 22 basis point spread. Now, yes, that's absolutely not wide, but it's still wider than it has been. Does that signal that perhaps things are normalizing in the financial markets as well?
I think it definitely helps with the curve on inverting, right, from the 3-month 10-year and the 2 10-year. The Fed also has some ammo left to cut one more time if need be, given the fact that the Fed funds rate is still above the 2-year Treasury rate. So that should provide a little bit more insurance to the market if the macro data does continue to deteriorate. But I would say, looking at kind of what is happening overseas and in the U.S., data is still bad, but it's not getting as bad, right? It's the rate of deceleration is essentially improving month over month. So I think the yield curve is telling us that if the August lows are in, you should see yields start to steepen out, and that's bullish for the stock market.
If that's bullish for the stock market, financials are a part of that picture and a big part of that yield curve conversation. Do financials now become one of those situations where investors can feel safe about buying into the bank stocks?
I think so. I think the valuation is relatively cheap on them. The yield is compelling enough for people to essentially exit the REITs and the utilities and staples, which valuations are very, very rich. You look at utilities and staples, they're trading about 21 forward times. It's essentially in line with tech, but yet less than half the growth on top line and bottom line. So the relative value is not there for those sectors right now if this durable sector rotation has legs to it.
Where is their value then right now? I mean, is it in those beaten up tech stocks as of late? Do you go back into those parts of the market that have seen some of the more industrial and cyclical and materials and technology type moves over the past couple of years reassert themselves in the next few months?
We really actually are on the contrarian side. We actually like healthcare here. We don't think the Medicare for all is actually going to happen. We think Americans can generally agree that medical health insurance for all is something that people would appreciate and want, but we don't think it definitely needs to be sponsored by the government. So CVS is a name that we really like. There's positive demographics there with aging demos. Huge acquisition with Aetna, which vertically integrates the company across retail, PBM, and then managed care as well. And they're converting about 15% of their stores to health hubs, which should essentially allow them to streamline more high-margin businesses and take them out of, pretty much backing up the Aetna hospitals every day. And at the end of the day, it trades at a significant valuation discount with United Health at about 40% turn. So that is a name that we like. They gave you the playbook at the Analyst Day in June. If they execute on that, the stock should re-rate over time. So that's definitely a name that's beaten up, and there's some good value there.
All right. Thank you very much. Nate Fischer over at Strategic Wealth Partners. We appreciate your thoughts.